Hello and welcome to the lecture for the second part of Chapter 9. So in this section I'm going to talk primarily about payroll and fringe benefits, and then I'll conclude by talking about the classified balance sheet, which is really important. So first, payroll. I assume most of you have had jobs and you've received paychecks before, maybe a summer job or maybe you work somewhere now. So a lot of this might be familiar to you, or it might explain things that you've seen, haven't known exactly why things were the way they were. So first of all, some definitions. So payroll is the amount that's paid to employees for their services. I distinguish that from subcontractors. So in some cases, some companies use subcontractors. They also might use employees. So the difference there is if somebody's an employee, that means that the employer directs them how to do their job, when to show up, what to do each day, how to get it done, what methods to use, all of that. Those people are employees, and we need to withhold income taxes and other kinds of taxes from their pay, and we need to match some of those as employers and pay that to the federal government. A contractor, in contrast, is somebody where we don't control their activities. We hire somebody to fix the furnace. They come in and fix the furnace at the company. They give us a bill. We pay them. They're not our employee. We didn't tell them when to show up or how to do their job or anything like that. For those kinds of relationships, we don't have to withhold payroll taxes. That's their business. Salary is the amount that's paid for managerial and administrative workers. Usually it's paid or described in a monthly amount. Somebody gets $5,000 per month, or they get $60,000 per year. That amount does not include overtime, or those people don't earn overtime. So they could work any number of hours. They could work 60, 80 hours a week, and that is their pay period. In contrast, wages are paid to hourly employees, so people that get paid for every hour of their labor. And that could be $12.50 an hour, or it could be $15 an hour, or whatever the hourly rate is. So the Federal Labor Standards Act, which is a federal law, requires any worker that works more than 40 hours in a calendar week to get 1.5 times their regular rate of pay for any hours over 40. So if you make, let's keep round numbers here. Let's say you make $12 an hour and you work 42 hours in a week. So the first 40 hours would be paid at $12 per hour, and then 1.5 times that rate, or $18 an hour, would be your overtime rate. So for the 2 hours you worked over 40, you would get $18 per hour for those hours. And that's a federal law. Employers can go above and beyond that. They could choose to pay double time on Sundays, or a higher rate if it's over 8 hours in a particular day. They could voluntarily choose to be more generous than that, but 1.5 times the rate of regular pay for hours over 40 is the federal law. That's the minimum. In Washington State, we describe salary versus hourly as exempt versus non-exempt. Those are the words that are used in Washington State law. Salary workers are considered exempt, which means they're exempt from you having to pay their overtime. And then hourly workers, of course, are non-exempt. In the state of Washington, there are 4 rules now about what would determine if you're exempt. One would be if you're managing 2 or more people, if you're a supervisor. One would be if you're engaged in professional activities, something where an advanced degree or certificate is required for your job. That would be doctors, attorneys, CPAs, things like that. The third is if you're involved in creative pursuits, and then the fourth is if you make under a certain dollar limit, which is going up every year. So total earnings is your gross pay. So in an example where you make $12 an hour and work 40 hours, then $480 is your gross pay for the week. Federal income taxes are withheld from that. So a company would look up on a table based on what you report in terms of if you're married or single and how many exemptions you have. They would look up on a chart to see how much should be withheld. that for your federal income tax, and that would be taken out of your check and sent on to the federal government. So the company's role is really just being a conduit of getting that money from you to the federal government. So they send that money to the federal government with your name attached to it. The reason that happens is the federal government doesn't want people to come to the end of the year and have not paid anything in on their taxes, because most people couldn't come up with their whole tax bill at once. So if it's done perfectly and you do your taxes at the end of the year, you should get no refund and you should pay nothing in taxes if the right amount has been withheld. The other kind of deduction is FICA. You may have heard that term. That stands for Federal Insurance Contribution Act, and it requires two different deductions from each person's check. One is for Social Security, so the money that you'll make, the money that you'll be paid when you retire, when you're over, I think it's 67 now. That amount is 6% of your gross pay up to $110,000. So it's a little bit higher than that, but the book uses 110. So you pay that tax up to $110,000. Money you earn above that amount is not taxed for Social Security. Medicare is 1.5% of gross pay, and there is no limit on that. And that's for medical care when you're retired, when you're older. So a person's net pay, the amount on their paycheck, will be their gross pay minus those deductions. There could be some other voluntary deductions too. Maybe your portion of medical insurance that the company offers, maybe some further retirement savings. Maybe there's a 401k plan you contribute to. There could be charitable contributions, say to United Way, that sort of thing. There could be union dues if you work in a union job. So all of those amounts would be deducted to come to your net pay, which is the amount people actually get in their paycheck. So in addition to the amounts that are withheld from an employee's paycheck and remitted to the federal government, that's federal income tax, Social Security, and Medicare, the employer or the business also has to pay some things on top of what is paid by the employee. So the employer has to match whatever is taken out of your check for Social Security. So say as an example, you make $100,000 a year and $6,000, 6% is taken out of your paycheck and sent in for Social Security. The employer has to match that $6,000. So they're going to send in $12,000 for you, 6 out of your check, 6 out of their bank account. The business also has to match whatever is paid in for Medicare. So in that example, you make $100,000 a year, $1,500 is sent for your contribution to future Medicare benefits. The business has to match that $1,500. So it costs the business more money to have you than just what you're paid. The business also pays into federal unemployment tax, that's FUTA, and state unemployment tax, that's SUTA. So the business pays into that fund based on their experience and what the rates are. Experience meaning how often do they lay people off and that sort of thing. That's paid into the government, and that's what funds if you get laid off and you need to file for unemployment tax, that's where that money comes from. So that's paid by the employer, not by you. So let's look at an example here. So we've got John Doe, very creative name I came up with there. 80 hours, so let's assume that's over a 2-week period, so no overtime. At $15 an hour less, $50 for federal income tax, and we came up with that number off of a table. 6% for Social Security and 1.5% for Medicare. So in that business, when that person finishes that 80 hours, that 2-week pay period on payday, we would record wages payable of $1,060. That's 80 hours times $15 per hour. No, excuse me. We would record wage expense, so we would pull down retained earnings by 80 hours times $15 per hour. That's $1,200. We would record payroll taxes that we owe. So that's the $50 plus 6% of $1,200 plus 1.5% of $1,200. That's $140 needs to be taken out of that employee's paycheck and sent to the federal government. So the wages payable, the amount that we actually owe the employee, the net pay, is $1,060. So then on transaction 2, where we pay the payroll, we're reducing cash by $1,060 and reducing wages payable. We're paying off that liability. Then the next step is we have to recognize that the employer has some responsibilities here. So we have to match the Social Security, which was $72 in this case, 6% of $1,200. We have to match Medicare, which was $18 in this case, $1,200 times 1.5%. And then we need to pay the unemployment taxes. So the state unemployment tax, or rather the federal unemployment tax, is 1,200 times 0.006. So that's how we convert 0.6% to decimals. 0.006, that's $7.20, and pennies will matter here. And then the state unemployment tax, 5.4%, that's 1,200 times 0.054, or $64.80 for $162. So that increases the payable that we have, the money that we have to send to the government, and it creates a payroll tax expense for the business. So that's why I increase the payable and record an expense for those payroll tax expenses. And then I pay the payroll taxes. I send the government their money. So cash goes down by 302, payroll tax payable goes down by 302, and notice that 302 is comprised of the money that we withheld from the employee's paycheck and the money that we as the business also owe. I'll do a sample problem of this and post a short video for that as well. So fringe benefits, those are things that employers don't have to provide, but they provide them in an effort to retain good employees and to attract employees. So things like vacation. There is no federal law that says that employees have to get vacation. Businesses offer that to attract people. Medical insurance. Now, if you're an employer over 50 employees, there are laws now about what you have to offer for medical insurance, but employers under 50 are not required to do that. Retirement benefits and so forth. So those are all voluntary things that the business does. So the key thing here, in order to have proper matching, is we want to recognize the expense and the liability when it's earned, not when it's taken. So as an example, if you have an employee that earns 1 day of vacation every month, so over the course of the year they have 12 days they could take. So in that case, in January, I would recognize 1 day of vacation day expense, and I'd have a liability for 1 day of vacation pay, the amount of that, and I would do that every single month. When the person takes their vacation, we'd be paying that liability, not recognizing a further expense. So I'm matching the expense associated with the vacation that the employee is earning in the period in which they earn that benefit. Okay, so again, we're going to be, when they actually take it, we're paying a liability, not recognizing an expense at that point. The last thing I want to talk about is the classified balance sheet. So we've talked about the concept of current assets, assets that either get used up or get turned into cash within the upcoming 12 months. So you can see here in this example, we've got cash, that's already cash, accounts receivable, which we'll expect to get paid within 12 months, inventory we expect to sell within 12 months to become an expense, and prepaid rent that'll become an expense within 12 months. So this company has $288,600 of current assets. Now the remaining assets we call property, plant, and equipment. So 475, so total assets is 763,600. We flip to the other side of the balance sheet, current liabilities, we talked about that. Current liabilities are liabilities that we have to pay in the upcoming 12 months. So here they've got accounts payable, money their suppliers have extended to them. A note payable, which must be a short-term note payable due within 12 months. Salaries payable, of course, people want to be paid quickly. And then unearned revenue, what we expect to do for the customer within the upcoming 12 months. So I've got current liabilities of $193,800, and then I've got one long-term liability, so that might be a long-term note, 5 or a 10-year note, and then stockholders' equity. So the reason for having this breakout like this is it gives more information to the reader of the financial statement. The key thing here, if you're a creditor, say this company wants you to sell them product on credit, give them 30-day terms, I would want to look at a balance sheet like this, and I would compare the current assets with the current liabilities. So 288,600 compared to 193,800, that's not great, but it's not bad. If we saw somebody, the rule of thumb is you'd want the current assets to be at least double what the current liabilities are in order to have a feeling that, okay, this company is going to be able to pay their bills as they come due. This isn't quite double. But if we had a situation where their current assets were less than their current liabilities, then under no circumstances would I grant them credit. So it's just a way of giving some more information to the reader of the financial statement. So that's the end of chapter 9. Again, I would encourage you to please send me an email or give me a call. If you have any questions, I'm happy to talk to you. So take care.